Mahesh Nandurkar, India strategist at CLSA, joins in with his sense of the markets. Mahesh, good to have you on the show. What is the outlook on the Indian markets that you're sharing with your clients? Can it deliver next year after the sort of subdued performance we've seen in 2018?
We have been sort of cautious on the Indian markets for some time. Some of that cautiousness has played out with the markets correcting over the last few months. But we feel that the combination of some of the macro concerns that we have had are still around, the primary being the rising interest rate environment in the country. We believe that the Indian economy and the corporate balance sheets have not yet fully factored in the cost of higher funds. So that's one thing that we need to keep in mind. The second concern, which actually has now got addressed to some extent with the oil prices correcting the way they have over the last 1 month or so, but our house view still remains that there is still an upside risk to oil rather than a downside risk. So not a big issue at this point in time, but something that we need to keep in mind. And also running up till the elections, there will be some political uncertainties and the impact that it will have on the investor sentiment. So these are really the three concerns or the three big things to keep in mind. And at the same time, the valuations have come down, but have not come down to an extent where we can really call it a value at this point in time.
Right. As you interact with FIs at this forum, what's the sentiment towards India? Are they worried about politics-related volatility? Do you expect growth ahead after correction?
No, a combination of various factors. From the foreign investors' point of view, India has always been, a long-term structural story, and we continue to believe that there are very strong building blocks that will take the GDP growth forward and at a more sustainable level over the next few years. But at this point in time, the foreigners are still, a bit concerned on the valuation front. Among all the major emerging markets, like the China, Brazil, Korea, Taiwan, etc. India stands out as perhaps the only major emerging market which is still trading at above its historical average PE multiple. All others are trading below their average multiples. So I think valuation is one key concern for foreign investors. And so long as we continue to have a strong domestic equity inflows, the valuation premium is likely going to remain, and that will probably be a factor that will continue to be something that will weigh on the minds of foreign investors.
Right. Mahesh, you mentioned about rising cost of capital. The market got a jolt from the recent credit crunch. How is it that you see this panning out? And if the impact is temporary, how should investors then play the sector?
So the situation is definitely improving on the liquidity side over the last 1.5 months or so. But my sense is that we need to be worried more about the second derivative impact rather than worry about NBFCs defaulting. I think it's not really a big system-wide issue at this point in time. Yes, there are a few NBFCs that might still have some problem, but many other NBFCs will still be able to survive quite well, but at the cost of giving up growth. So some of these NBFCs will need to bring down the growth quite a lot, and to that extent the segments or the industries that NBFCs lent in a meaningful way will probably have to also take in that much of a lower growth. So our sense is that things will ease out on the liquidity front as we go ahead, but in the interim period we'll need to be content with slightly lower growth at the broader economy level than what we have been used to.
Okay. Mahesh, you mentioned that India is still trading at a PE higher than historical averages. We're coming to the end of the earnings season. What are your key takeaways for the rest of the fiscal? Can we see a marked improvement coming in?
Yeah, so the September quarter, earnings, season wasn't really particularly exciting. When the street and ourselves ended up cutting the earnings estimates, at a pretty steep rate. On the positive side, what we clearly saw was that the NPL ratios for the banking system has been coming down. And while the provisioning costs were up, but that's still a welcome sort of higher cost, because it gives that much more visibility on reaching the final conclusion sooner rather than later. On the positive side, we saw the consumption trends being somewhat better, especially on the rural side and the low ticket item side. And we also saw the IT hiring picking up quite nicely to a level, the highest level that we saw in the last 6 to 8 quarters. So those were a few brighter spots, but by and large the earnings season has been quite weak. Going forward into the second half, we will probably still need to deal with the full impact of the liquidity issues and the higher cost of funding, etc. But FY20 definitely looks like a better year because banks, which is the big segment of the index, and the corporate banking issues seem to be close to be getting over, or the NPL ratios are close to be picking out. So FY20 definitely should be a better year.
What do you make of the prolonged weak housing cycle, along with government support that has brought housing affordability at its best level since 2003? Are we at an inflection point?
Yes, we have been actually quite optimistic, on the housing sector for a while, but there have been sort of various external events which have kept on postponing the housing recovery. First it was the demonetization, there was the RERA implementation, GST implementation itself, and now with what's been happening with the sort of NBFC sector in terms of the liquidity issues. But having said that, the housing affordability is at the best levels that we've seen kind of since 2003, as you rightly mentioned. So ingredients are clearly there, but with this liquidity issues, my feeling is that the recovery gets pushed out a little bit, but it's just a question of when and not if. I was much more positive on this housing recovery in the shorter term about a couple of months ago, but my sense is probably now we'll need to wait for another couple of quarters.
Right, there are early signs of Capex revival. How would you play that theme?
Very selective, in my view. I mean, the segments where we are seeing the capacity utilization has been inching up, like steel, for example, or maybe a certain durable segment where, we have seen some capacity improvement, like autos. But the broad-based Capex cycle recovery, I think, is still elusive at this point in time. And my sense is, once again, the bottom of the Capex cycle revival, would be linked with the housing market, sort of bottoming as well, because housing is actually a big driver for economic growth and consumption for various items like cement and the other items. So we clearly need the housing market to recover for the Capex cycle to recover, in my view.
Okay, any themes then that you're betting on for 2019?
So I can't talk about individual stocks, but at the sectoral level, we still feel that the currency is still going to be in the depreciating mode, and the domestic Capex cycle revival will still take some time. So our overweights are still the pharma and IT services sector. We quite like the domestic, especially the rural consumption story. So there are plays, on the rural consumption stories like the tractor manufacturers, and a few, select FMCG companies. We also like, from a long-term perspective, as I said, the housing market recovery, and to that extent the property developers will be beneficiary of that. And the property developers are also seeing the benefit of industry consolidation. So while the market recovery itself might take time, but the industry consolidation will help the listed property developers. So that's the other segment that also we like. And we are funding this out of running underweight on telecom, running underweight on materials including cement, and we are also underweight on NBFC space, largely speaking, which results in we going underweight on the financial sector as a whole.
Mahesh, such a pleasure speaking with you. Thanks so much for taking the time. I'm glad that you could take time out on the sidelines of the conference and join in for a chat.